Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to cover a very important RBI notification, the finance current affair that has been recently released. Okay, so RBI has released a notification regarding the small finance bank and how the small finance bank can transition to the universal bank. So the guidelines have been provided by the Reserve Bank of India that we are going to understand today. So RBI lays out a roadmap for voluntary transition of small finance banks to the universal banks. So we will understand all about this news article, and this is very important because direct questions can come in the objective part of the examination in the RBI grade B, NABARD grade A or SEBI grade A examination. Okay, so for all the examinations this news article is very important. Okay, so let's get started, but before that do subscribe to our YouTube channel and join our Telegram channel, because in the Telegram channel you are going to get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So good morning everyone, so good to see all of you here. So let's get started with the topic for today. Okay, so voluntary transition of the small finance banks to the universal banks. For this, the guideline has been released by the Reserve Bank of India. Now the guidelines, see, the Reserve Bank of India came out with the guidelines recently, and the guidelines for on-tap licensing, which was released in 2019. In that it was said that there will be the transition that will be allowed for the small finance banks to the universal bank. So in 2019, in the previous guidelines, it was clarified that we are going to provide, or there will be a transition path for the small finance banks to the universal banks. In the recent notification of the Reserve Bank of India, the RBI just have provided the clarity that how the transition can happen and what are the eligibility criteria for transitioning from the small finance bank to the universal bank. So there are the clear guidelines, the clear-cut points, eligibility criteria that has been provided. So in 2019 it was only said that yes, the small finance banks can convert to the universal banks, but now in the recent notification there is the clear-cut guidelines that have been released for the transition. Okay, so who are the small finance bank? Which are the small finance bank? So small finance bank are the differentiated banks that have different roles and responsibility. Okay, that means they have specific roles and responsibility. So you must have seen the AU small finance bank, the Ujjivan small finance bank. So there are multiple small finance banks that are present in our country. So the small finance bank, they shall be registered as a public limited company. Public limited company means that they should be recognized in the stock exchange. Their shares are being sold in the stock exchange. There are the shareholders, and the small finance bank is being run by the shareholders, or we can say the small finance bank is being managed by the shareholders as well as the directors. So that is the public limited company. Under the Companies Act of 2013, the small finance bank should be registered as a public limited company. So there should be shareholders that should be present of the small finance bank. The small finance banks will be given scheduled bank status once they commence their operation, and the small finance bank, they have the particular objectives to reach to the unserved or underserved areas where the other banks are not present, where the SBI, PNB and such banks are not present, to be available there also, as well as to supply the credit to the small business units. Let's say that you want to have the credit of 5 lakh. Okay, you are a street vendor, you want to have the credit of 50,000 or 1 lakh, and you are afraid to go to the SBI or the PNB because they are the big bank branches, as well as they require a lot of documents. So what will you do? You can go to the small finance banks. There are the small finance banks that are provided for this basis, for this particular reason, that they provide the small finances to the small business units, to the small and marginal farmers, to the micro and small industries and the other unorganized sector entities through high technology, low cost operations. So the small finance bank, they are under the category of differentiated banks because they provide the different activity, they provide the specific banking activity that is going to help the savings for the unserved and the underserved sectors, as well as they provide the loans, the credit to the business unit, to the small units. Okay, that is the small finance banks. So the minimum paid up capital requirement for the small finance bank is 200 crores, that there should be this much minimum capital that should present for becoming a small finance bank, for opening up as a small finance bank. So this is the basic idea of the small finance bank. So the small finance bank, primarily they undertake the basic banking activities of accepting the deposit from the unserved, underserved area, as well as providing the credit to the small units. The small finance is provided by the small units, and it is compulsory for the small finance banks to have the small finance bank in their name. So Ujjivan small finance bank, the AU small finance bank. So all the small finance bank, they need to keep the small finance bank in their names itself, so that the people easily identify that okay, this is the small finance bank and we can take the small finances from this particular bank. So that is the idea. Okay, it can also undertake other non-risk sharing simple financial service activities such as the distribution of mutual fund units, insurance products, pension products, etc. with the prior approval of the RBI. So the basic financial activities can be done by this small finance bank also. But they require the prior approval of the Reserve Bank of India, that is for the period of 3 years. Like after 3 years from the date of commencement, they would not require such separate approvals. They can do the functions as per the guidelines that is provided for the scheduled commercial banks. Okay, so the basic idea is that the small finance bank are doing the basic banking services, and that also for the differentiated purpose, that is for the particularly for the small businesses, particularly for the small finance that they are providing, and they are serving the underserved or the unserved areas. The universal banks are such as the SBI, PNB, that are the big banks. They are the one-stop solution for all your financial needs. Okay, so they are categorized into 3 types. They are providing the retail banking to all the customers. Let's say Ambani wants to take a loan, or Adani, Tata family, or any big business want to take the loan, they can take the loan from the universal bank. Or let's say the small vendors, the marginal farmers, they want to take the loan, they can also take the loan from this universal bank, though it can involve multiple steps. But the retail banking is provided by the universal banks, that is the everyday banking services. You want to deposit your funds, you want to take the loan, you can do so with the universal banks. It also involves the wholesale banking services, such as let's say that one company has 5 lakh employees. All the 5 lakh employees, there are the PF funds that are required. Okay, so for that you have to open the account. So this 5 lakh accounts will be opened by a particular bank. So the company is getting into an agreement that this particular bank will have the PF accounts. Okay, so this is the wholesale banking service that is being provided by a particular bank, that can be done by the universal bank. These universal banks, they provide the wholesale banking service also to the companies for opening the pension fund accounts, or for opening the accounts for all the employees, that is the salary accounts we can say. Okay, next is it encompasses investment banking services. Asset management you want to do the advisory, you want to undertake, or you want to take the investment advisory, or if raising the capital, mergers and acquisitions, securities underwriting, securities trading, the asset management, the investment advisory services, all of these services can be provided by the universal bank. So universal banks are the big banks that are one-stop solution for all your financial needs. They can provide the retail banking, wholesale banking, as well as all the financial services they can also undertake. The investment banking services they can also undertake. Okay, so I hope this is clear that how different the universal banks are from the small finance banks. Small finance bank are particularly for the unserved, underserved area, and to provide the loans to the small units, but the universal banks are for all your banking services, let it be the retail banking, wholesale banking, or the universal, like the banking that you are doing, the investment banking services that you want to undertake. Okay, so the universal banks can provide all of these. Now, what are the provisions for the small finance bank to convert into the universal banks? Till now, is it clear? Give me a thumbs up if everything is clear till now. You have understood the difference between small finance bank and the universal bank. So this, it has been said by the RBI that the small finance bank can transition into the universal banks, but there are some norms that have to be followed. Okay, so till now everything clear? So with the objective of bringing better clarity, the eligibility criteria has been provided by the Reserve Bank of India, that how the small finance bank can transition into the universal bank. Okay, let's see the criterias now. Let's see the provisions now. That the scheduled status with a satisfactory track record of performance for a minimum period of 5 years. That means the small finance bank should have the scheduled status, that is small finance bank is working as soon as the small finance bank commences its operation. We have understood now that as soon as the small finance bank commence its operation, it gets the scheduled bank status. So the small finance bank should have commenced its operations, should have got the scheduled status, and then it should have a satisfactory track record of performance for a minimum period of 5 years. That for the 5 years it should be working in a good manner. Then shares of the bank should have been listed on a recognized stock exchange. I have told you that the small finance bank are registered as a public limited company under the Companies Act of 2013. So that means they are the public limited company. That means they should have the shares in the recognized stock exchange. The shareholders should be present. Okay, that means shares of the bank should have been listed on a recognized stock exchange, and that's why it is a public limited company. See, private limited company is a company that is not registered, that is not selling its shares in the stock exchanges. That is private limited company, that is in the private hands, that is not available to the public. Public limited company is the company that is available to the public through the shares. So there are the shareholders that are present for the public limited company. So if you want to convert into a universal bank, your shares, the small finance bank shares should be listed in the recognized stock exchange. Having a minimum net worth of 1000 crores. For opening a small finance bank, the minimum net worth is 200 crores. But to transition into the universal banks, you should be a big bank that can handle the situation. Okay, so having a minimum net worth of 1000 crore at the end of previous quarter audited. Okay, having the gross non-performing asset less than or equal to 3% and the net non-performing asset less than or equal to 1%. That means gross non-performing asset should not be more than 3%. Net non-performing asset should not be more than 1%. Non-performing asset are the loans that you have given. Now they are not coming back for more than 90 days. Okay, so that are the non-performing asset. So your non-performing asset, the gross should not be more than 3%, net should not be 1%, more than 1% in the last 2 financial years. Having a net profit in the last 2 financial years. So there should be a net profit in the last 2 financial years, meeting the prescribed CRAR, that is the capital to risk weighted asset ratio. So the assets that you are giving or the loans that you are giving, that is the asset for a bank. Because on this loan you are earning the interest. So this is the asset that you have. Now the loans that you are giving, they have some risk weight attached. So let's say you are giving loan to the small and marginal farmer. So it has the risk weight of 80%. You are giving loan to a street vendor that has the risk weight of 100%. So such risk weights are attached to the assets. Against these risk weight, you have to maintain the capital. So for the small finance bank, in the view of the inherent risk of the small finance bank, because they are giving the loans to the small vendors, to the street vendors, to the small and marginal farmers. Now small and marginal farmers, they might default because of the condition of the because of the natural condition, their crop might fail and they might default. So, and the street vendors also, they may be not able to work as efficiently, or they may be not able to sell as much, so they are not able to return the loan, return the money. So there is the inherent risk of the small finance bank. So they are required to maintain a minimum capital adequacy ratio. The CRAR, that is the capital to risk weighted asset, they have to maintain 15%. That means if the risk weighted asset is 100, the capital that they have to maintain is 15 rupees. So that is the idea, meeting the prescribed CRAR requirement for the FBs. So if the small finance banks have the CRAR with them and they are meeting the CRAR requirement, then only they can transition to the universal bank. Okay, so Vikrant is asking me the difference between the gross and net NPA. Gross NPA is the total non-performing asset. It is the total doubtful asset, or the asset that is not coming back, that is the gross non-performing asset. Now net NPA is that after the banks are keeping the capital, the banks are keeping the provision against the asset, against the risk weighted asset. So after deducting your provisions from the GNPA, from the gross non-performing asset, let's say the gross non-performing asset is 1 lakh rupees. From this, the bank has the provision, the bank has already kept the provisions of 90,000. So the net non-performing asset is only it is only 10,000. That means this much of the provisions the bank has not kept, and this is actual loss that the bank is going to handle. Okay, so gross non-performing asset is the total money that is not coming back, the undoubtful assets, the assets that are not coming back, the loans that are not coming back. So that is the gross non-performing asset. From the GNPA, if you deduct the provisions kept by the bank, whatever is left, that is the net NPA, that is the actual loss that can be suffered by the banks. Okay. Yes. Yes, Aman. So this is higher because of the small finance bank are having the inherent risk. Okay. So now coming to the provisions, further provisions. So these were the provisions for the transition of the small finance bank to the universal bank, that the banks have to maintain some percentages, some minimum capital and such. Now coming to the shareholding pattern, as I've told you that they have to present their shares in the market also. So what should be the shareholding pattern for the small finance bank to convert into the universal banks? So there is no mandatory requirement for an eligible small finance bank to have a identified promoter. So it's not like that you should have a big promoter. No, there is no such requirement. Okay. Just, however, the existing promoters of the eligible SFB, if any, shall continue as the promoters on transition to universal banks. That means these are the promoters. These are actually the people that have established the small finance bank, that have worked for the small finance bank in the starting. So this shows that how is your management, how are your promoters, how trustworthy they are. So if the Reserve Bank of India is doing the research and is giving you the license for the universal bank, you should not change your promoters instantly. So that is the idea, that the existing promoters of the eligible SFB, if any, shall continue as the promoters of transition to the universal bank. Okay, so shall continue as the promoters on the transition of universal bank. Addition to new promoters or change in promoters shall not be permitted for an eligible SFB while transitioning to the universal bank. So if there is the addition to the new promoters or change in promoters shall not be permitted. As I have told you that the promoters should not change, because seeing the current promoters, seeing that how they have worked for 5 years, how they have run this small finance bank for the 5 years, how they have led this small finance bank, due to this the Reserve Bank of India is providing the transition path for the small finance bank to the universal bank, or is allowing the transition. But if the promoters change, that means the whole system can change, their ideology can change, their idea of running the business can change. So that should not happen just after you have become a universal bank. So addition of new promoters is not allowed, or change in promoters is not allowed, is not permitted for an eligible SFB while transitioning to the universal bank. The eligible SFBs having diversified loan portfolio will be preferred, because this shows that okay, they have the capacity to cater to different businesses. Okay. Next is there shall be no new mandatory lock-in period for minimum shareholding for existing promoters. So as you know that for all the banks there is some minimum lock-in period. Okay, that is the promoter shall hold a minimum 40% of the paid up equity capital of the bank at all times during the first 5 years, because this shows how much trust you have on the bank, and you are the promoter, you are the establisher of the bank, you are the major establisher of the bank. So you should be having the trust on that bank, and you should be holding the near to the maximum equity with yourself, okay, to show the trust on that bank. From the date of commencement, so there are some lock-in periods that you can read. I have taken this from directly from the guidelines of the SFB, so you can read it. So it has been said that there shall be no new mandatory lock-in requirement. Whatever the lock-in requirement is for the small finance bank, that will continue for even if you are transitioning as a universal bank. So there shall be no new lock-in requirement of minimum shareholding for existing promoters in the transitioned universal bank. Whatever lock-in requirement was given to you in the small finance bank, that will continue. Okay. There shall be no change to the promoter shareholding dilution plan, that how you are diluting your shares after the 5 years, you have to decrease your shares and such. So how you are diluting your shares, so that plan should not be changed also. So there shall be no change to the promoter shareholder dilution plan already approved by the Reserve Bank. So this will not be required. Okay, Aman, I will have to check also, because in the guidelines it was said, in the guidelines of the Small Finance Bank, it was said that the Small Finance Bank will have to maintain the capital adequacy ratio of 15%. Okay. So, and it was said that the tier 1 capital have to be maintained of 7.5% in the minimum, and the tier 2 capital has to be maintained of tier 1 capital has to be maintained of 7.5% minimum. Okay, and that means it can increase also to 9% to 10%. As per that, tier 2 capital will depend. So it was, let me show you. Okay. So it was said that the Small Finance Bank have to maintain the capital adequacy ratio of 15%, out of which the tier 1 capital should be minimum 7.5%. Minimum 7.5%. It can be 8%, 9%. And tier 2 capital, depending on that, tier 2 capital cannot be more than 7.5%. Cannot be more than 7.5%. So this was said as per according to the capital adequacy ratio. Tier 1 capital is the liquid capital, tier 2 capital is not so liquid capital. So liquid capital has to be maintained minimum of 7.5%. You can maintain higher also, 9%, 10%, and tier 2 capital cannot be more than 7.5%, because this is the minimum that has to be maintained in tier 1 capital. Seeing this, I will say that the CAR, that the capital conservation buffer is different, but I will have to check that. So you can comment down below in the video section also. So I will check this and will confirm to you. But according to me, this is the bifurcation that was given in the website. There is no separate CCB that was mentioned. But 2.5% is the capital conservation buffer. If the tier 1 is 7.5%, tier 2 is 7.5%, then separately, yes, the CCB will have to be maintained separately. That is the idea. But I will have to check this again. Okay. Yes, yes. So this is the complete idea, that the tier 1 minimum is 7.5% and the tier 2 cannot increase more than like tier 1 capital. So this is the first question. I hope you will be easily able to answer this question. So read this question and try to answer this question. Even the private banks can also be universal banks, like the HDFC Bank and such. So if they are providing the wholesale banking services, or if they are providing the retail banking services to the whole segment, they are the universal banks. Okay. So this is the first question. I hope you will be able to answer this question, and this is the second question. I hope you will be able to answer this question also. I have told you that the CAR, that is the capital adequacy ratio, is 15% required for the Small Finance Bank, out of which 7.5% tier 1 capital has to be maintained, and this is the minimum that has to be maintained. Tier 2 capital, they can maintain it 7.5%, and this is the maximum tier 2 capital that they can maintain. Okay, so this is the capital adequacy requirement. Okay, so now before finishing this session, there is a big announcement from EduTap that we have brought for you the comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebook you are able to get much of the information regarding the pattern of the examination, regarding the syllabus of the examination. Even with this guidebook, you can get the previous year question, and this is absolutely free of cost, to save your time, to save your efforts. So you can download these guidebooks. The link is provided in the description box below. Okay, so do give me the right answer of the homework questions, as well as comment down below if you have any query. Okay, I have told you Aman had a query, so I will check it also. Aman, I have told you the basic idea of the CAR and the division of the CAR, but I will have to check. According to me, yes, the CCB can be separately, can be there separately. Okay, so thank you very much everyone. Let's meet for the next session. This is the whole guidelines for the transition of the small finance banks to the universal banks. Okay, you are most welcome Nilesh, you are most welcome Pratul and Padmini. Thank you for attending the session everyone. You are most welcome Manas. Thank you for attending.